Hello friends, Rajesh here. Welcome back to Invest and Grow. Today let's discuss about one of the famous insurance product, annuities. Annuities is at least pretty famous in here in US. I'm sure that there would be similar equivalent products across globe. Let's discuss what is this annuities all about, and also let's review with a specific sample using an annuity online calculator to go over in detail. Alright, if you are here for the first time, consider subscribing to this channel. Let's get started. As it is an insurance product, unlike a conventional insurance product, whether it is a life insurance or a term insurance, it's all about death benefit. Wherein annuity, it's all about actually someone who's getting into this agreement, receiving the benefits. So, what is this annuity? It is an agreement between the contract holder and the insurance company. The contract holder pays a lump sum of amount in form of a payment for which eventually the insurance company agrees to pay a sequence or a form of payment after a set particular time. It could be an immediate near term or in a future some point of time. So it is basically a contract between an individual and an insurance company. So what is the benefit of an annuity? It proves as an additional retirement income. Let's say when you are young, you have amount to manage, wherein after retirement you are potentially looking for an additional source of income. This additional source of income, annuity is one great product. What is the drawback? The real drawback is that the cost of annuity. It could get expensive, so you actually putting in a lot of money, and for the hope that towards the end of your retirement or towards when your retirement starts, you receive a considerable consistent stream of income. It has both pros and cons. All right, let's review in like a sample and go over an online calculator to go over this in detail. Okay, so let's say after retirement, let's talk about like after 65 years of age, you wanted to get started on your annuity. Let's say your withdrawal amount is going to be or the amount that you're looking to get is $2,000 every month after your retirement. So let's also determine, like, this calculator helps us to determine how much is going to be a principal amount that you will have to put as a starting amount for which you will get the steady stream of income. So we said that we want $2,000 to begin with, and at an annual growth rate of, let's say, 5%. Let's say the amount that you invest is going to grow as a 5%. Let me actually maximize a bit in case. It's okay. Okay, so the length of annuity in years. For example, if you wanting this in your age of 65 and you are looking at additional 20 years, let's put as 20 years, hoping that this example individual is going to live for 85 years. Let's calculate. So if you look into this one, if you want an retirement income of month-on-month income of 2,000 after your particular age, for 20 years, what you're looking at is that you're looking at the initial investment of 300,000 roughly. So that is what it's all about. So you will eventually end up in paying the insurance company this 300,000, and they're going to invest in certain assets, and you're also telling them that you want the annuitization for 20 years, and this is how it will be spread across. And let's look into the annuitization chart. So the closing balance of this amount actually begins of 300,000, and as the periodic payment starts, we are talking about 20 years, so which literally translates to 240 payments, right? And as the beginning of it, the amount is 300,000, and as the payout starts, the amount consistently decreases. So towards the end of the 20 years, you would have received a steady stream of 2,000 month-on-month basis, and wherein after the 20 years, you get your payout. So this is on a very high level. Now, having gotten this context, let's get into this details on looking into some of an examples and types out here. So there are two types of annuities. One is the fixed annuity, and other one is variable. Let's say if I am a conservative investor, I do not care like how much the insurance company is going to make. Rather, I want to give a set amount. Let's say in this example, 300,000, and I'm okay with the month-on-month income of 2,000. I invest in fixed annuity. So all insurance company will do is that they absorb all the risk. Let's say moment they get the amount, they are going to invest in somewhere, because otherwise they're going to not cope up with the inflation. So the 300,000, the insurance company invests somewhere, and they make a promise to you that for the next 25 years they are going to pay you an amount of $2,000. So this is in straightforward. While this in lucrative or an interesting option for as an investor or a contract holder, one thing to keep in mind is that it won't cope up with the inflation. The let's say for the person who is retiring at the age of 65, first couple of years the 2000 may be okay. Down the line, because of inflation, the 2000, the buying power is going to decrease. So one thing to keep in mind is that when you invest in a fixed annuity, you are taking a hit on inflation, so the money is not going to grow over the time. So all the time, every month, you are going to get a return of 2000, payment of 2000, say starting from 65 years until the age of 85. So in order to combat this inflation, insurance company introduced this variable annuity product, which is great, right? So what they do is that they invest this amount in let's say in stocks, literally in stock markets. So what happens is that the risk is absorbed by the contract holder, meaning since you wanted to ensure that you wanted to receive a better payment towards when the annuity period starts, you are telling the investment company, the insurance company, that you invest this amount in equity, stock market, or wherever the right form of investment, and in order to receive a slightly better, more income month on month, they are going to invest in various stock portfolios. So the hope is that you are going to get returns over $2,000. In this case, it could be like 2,500, 2,600, depending upon how your portfolio returns. The risk is on yours. Let's say your portfolio performs badly, you have a risk losing this amount. The payment could go less than 2,000, or in worst case, your entire payment can go for drain. But it's unlikely scenario. But in an ideal scenario, in order to beat the inflation, you wanted to be a better investor and invest in a variable annuity. It is all depending upon individual's risk appetite, but one thing to keep in mind is that fixed annuity is not going to cope up with inflation. All right, having gotten the types of annuities, let's look into some of the nuances or phase. The accumulation phase and annuity phase. Let's say an individual who's of 50 years wanting to or preparing for their retirement in 65 years. So they say that they are going to invest in this annuity for next 15 years, which is an accumulation phase. So during the accumulation phase, you have all the luxury to take the amount that you want. To surrender the policy for various reasons. You think that after 10 years down the line, you say that I have enough retirement, I do not want this annuity to come later in the time. You can withdraw the amount. There is going to be a slight penalty depending upon based on your age bracket, but at least the amount is something that you can get back if you wanted to surrender during the accumulation phase. Wherein the annuity phase, meaning once the accumulation phase is all done, you are saying that okay, now I am like 65 years and I wanted to get my policy annuitized, which means that your payout actually starts. Once your payout starts, there is no way of going back and asking your money, and you cannot opt out. So that is a key thing to note. Once the annuity period starts, then you're all locked up. Having gotten these phases, one thing important to understand is the payout option. There are various payout options that an insurance company would provide. One thing is the straight life annuity. So what this simply means is that, let's say you going with the same example, 300,000, you wanted to optimize your investment, right? And you're saying that just literally dividing this 300,000 for 20 years, the maximum return that you could get is like in 2,000. And to be on a safer side, you always wanted that I wanted to max out my payout option. Then straight life annuity is an option, and they agree to pay this maximum amount. The key item to note is that they will pay until your lifetime. So in this case, they will, let's say the average, they will do all the math of this average individual lives for, after the certain age, they will live for another 10 years or 20 years depending upon their age bracket they are in. Investment, I mean the insurance company ingests the risk of if they outlive their life. Let's say this person of 85 years lives until 100 years, they are still obligated to pay this for this entire straight life annuity. That is the biggest benefit. On the other hand, if you look into the life annuity with period certain, this is an option in which you say that I just want for like another only 15 years. In this example, so the biggest benefit for insurance company is that they are getting locked up only for the certain years of for which the particular the insurance, I mean the contract holder says. So only for the 15 years, the insurance company is committed to give the amount. The biggest difference is that in case, let's say, after within this 15 years, any beneficiary who the insurance holder, I mean the agreement contract holder says that in case if there is a life risk to this person, and if they are within the 15 years, let's say the person passes away in 5 years, at least for the next 10 years, the amount will be received by the beneficiary. So the biggest difference between the life annuity with period certain and the life straight annuity is that in straight annuity, the beneficiary, there is no concept of beneficiary getting benefited, wherein the life annuity with period certain, at least the beneficiary has an option in case the primary the insurance person passes away. So hope that provides some context. There are various nuances and further details. At least this gives us or exposes out what is the high level detail of annuity and various types available. If you have any thoughts, comments, leave your comments. And if you like this video, give the thumbs up and consider subscribing to this channel. Thank you.